Welcome to the Rob Berger Show. We are continuing our series on how to invest with confidence. Recall in the last episode, we looked at whether you should pay off all your non-mortgage debt first before investing. I generally think for most people you shouldn't, and I explained why in that video. In today's episode, what we're going to look at is an objection that I hear a lot, and that is, I don't have much money to invest. And the objection usually takes one of two forms. The first is either, look, I could invest a little bit of money, but what good would it do? If I can invest $5 a day, that's $150 a month. What's the point? Or some might even say, look, I can only invest, say, $1 a day. That's $30 a month. It's just not enough to make a difference, so why bother? The second objection I hear is, look, I might be able to invest relatively small amounts of money, but where do I do that? Don't you have to have a lot of money to invest, say, I don't know, $100 a month? The big brokerage firms aren't going to take that kind of money, are they? Well, those are the two objections we're going to address today. And I want to start with the first one. And so looking at the screen, I have just finished building this simple savings calculator, and fingers crossed that it works. And what I want to assume, let's start with this idea of saving $5 a day. Let's imagine you're 20 years old and you're going to save $5 a day. That's $150 a month until you retire. So that's 45 years later. That's an awfully long time. But how much would you have? So we'll start with zero. You don't have an initial investment. And again, at $5 a day, your monthly contribution would be $150. And we're going to do this for 45 years. Now, the APY, I'm going to actually show you another page very quickly. This is a page on Vanguard, which is a mutual fund company. And what they show here is the average returns of portfolios dating all the way back to 1926. If you look at data, actual market returns from 1926, and this was last updated through 2018, what were the average returns for different asset allocations? You can see here they start with a portfolio of all bonds, no stocks at all. And the average return, as you can see, was 5.3%. And if we go all the way to the bottom, just the opposite, a no bonds, all stock portfolio returned 10.1%. I think for this video, we'll just assume 9.1%, which would be the average return for a portfolio of 70% stocks and 30% bonds. I will leave a link to the calculator below the video. And by the way, if you're listening to this via the podcast, you can check out the video by just going to robberger.com/YouTube, and that will redirect you to the YouTube channel. But we'll use 9.1%. Of course, as you're experimenting with this, you can use a variety of interest rates, whatever you'd like. So we'll put 9.1% in. Any idea what this is going to turn out to be? When I ask people to guess, the most popular guess, I would say, is somewhere around $500,000. Well, as you can see, the total is quite a bit more. It's over 1.1 million. The real number, though, that stands out to me is how much the interest earned in an investing world. You could think of that in terms of not just interest from bonds, but also dividends from stocks and the overall growth in the value of the stocks and bonds. Is over $1 million, whereas the total contributions are 81,000. And this is the part that I think stumps so many of us, myself included. It's hard for us to truly grasp this without actually seeing the numbers in a calculator. $150 a month, it just doesn't seem possible that it could turn into this much money, even over a long period of time, like 45 years. And yet it does through the power of compounding. Now, I know some of you may be saying, look, Rob, I can't even contribute $150 a month. That's fine. Let's assume $1 a day. That's $30. Still turns into almost $250,000 over a working career. Now, these assumptions aren't completely realistic in the sense that it's unlikely that over a 45-year period, you would only be able to contribute $30 a month. Hopefully, as time goes by, even just with inflation, you should be able to contribute more. And of course, the purchasing power of this money 45 years from now will be a lot less. Again, offset somewhat by increases in your contributions. But the real takeaway is this: investing even relatively small amounts of money over long periods of time turn into piles of cash. Now, some of you may be saying, look, I'm not 20 anymore, I'm 40 or I'm 50. Yes, as the time periods get shorter, of course, the total savings go down. But no matter where you are in life, starting to invest now for your future will be much better than if you didn't invest at all. And in fact, let's just use $100 as an example. And let's say you're 40 now, and so you're going to retire hopefully at 65, let's say. So that's still 25 years. And if we run this calculation, it's still over $100,000. And again, this doesn't include any increases in the monthly contribution. If you're investing at work, it doesn't include any employer matching contributions. And so what seems like a relatively small amount of money, even over shorter periods of time, well, it still turns into a pile of cash. So that's the first objection. I've only got $1 a day, $3 a day, $5 a day. It's not going to make a difference. Well, it will if you give it enough time. Now, the second objection would be, well, okay, let's assume I've got $100 a month. Where can I invest that kind of money? Don't these accounts require minimum deposits of thousands of dollars? Well, in some cases they do. One of my favorite investment companies is Vanguard because they offer low-cost index funds. But yeah, their minimum investments are usually $1,000 to $3,000, and in some cases even higher. So one option there would be to save up the money in a savings account, and once you reach the minimums, go ahead and open up a Vanguard account and begin investing. But there are other alternatives, and I want to show you a couple. The first one would be your 401k. And my 401k is at Fidelity through Forbes, where I work. And I can contribute as little as 1% of my income. So if we were to imagine, let me pull up a calculator, someone making, say, $40,000 a year. And if they contributed 1% of that, of course, that's $400. And divided by 12, that's only about $33 a month. So, of course, the amount will vary depending on the percent you choose and your income. But you can generally invest relatively small amounts of money in your 401k, 403b, or other workplace retirement account. That would certainly be the best option, particularly if your employer matches some or all of your contributions. Now, moving beyond retirement accounts at your employer, there are other options, whether you're investing in an IRA that you open up yourself or even in a taxable account. And as some examples, we're going to stick with Fidelity. This is what's called the Fidelity Zero Large Cap Index Fund. It's called Zero because Fidelity doesn't charge any fees. You can actually see here under the details, the expense ratio is 0%. And don't worry if you're not familiar with the expense ratio. We will be covering that in this series as we move forward. But it's free, effectively. That's what that means. And actually, with Fidelity, there is no minimum. In fact, if we scroll all the way down, I think we'll see that here, maybe. Oh, here it is. Yeah, the minimums. Initial investment, there's none. Additional investments, you could start with $25, or in our example, $100, and add to it any amount you wanted to each month. And that's true not only in a taxable account, but as you can see here, also true with an IRA. So there's one option, Fidelity. Another option that I like is called Acorns. And see if we can go to a better page. Here it is. And Acorns was originally designed as a smartphone app. And the idea was you could invest your change. So the idea was you would, as you used your credit and debit cards that were connected to the Acorns app, they would round up all of your purchases and sort of save that money out of your checking account. And then once it reached at least $5, they would invest it for you, effectively in low-cost index funds. Again, don't worry if those terms are new to you. We will be covering them later in this Invest with Confidence series. But it was really an almost painless way to invest. You didn't really have to do anything but just go about your life as normal. Acorns sort of monitored all of your transactions on your credit card or debit card that you choose to connect to the app. and would round up the purchases. And once it reached $5, take that money from your checking account and invest it for you. You can now invest directly with Acorns. Apart from that roundup feature, the roundup feature still exists, but you can also just invest like in an IRA directly with Acorns with a $5 minimum. So it's very, very low dollar requirement, and is another example of a way to invest $100 a month or even a much smaller amount. And just to show you, here's the page which shows their minimums, and as you can see, they say right there, to start investing, your roundups or one-time investments must add up to at least $5. A third and final option, I guess this would be the fourth option, is Betterment. Now, Betterment is what's called a robo-advisor. It's kind of, I guess, similar to a Vanguard or Fidelity. You invest in Betterment, and they take your money and they divide it across a number of and they use ETFs, but they're effectively similar to index mutual funds, and they do all that work for you. It's very easy to set up. I actually met the founder of Betterment, oh goodness, probably 10 years ago, and have followed the company since then and have had him on my podcast. And as you can see here, for what they call their digital account, the annual fee is just 25 basis points, which is relatively inexpensive. And as you can see, the minimum balance requirement, 0. And you can add to this account on a monthly basis. And it's another great way to invest $100 a month or even a smaller amount. So the big takeaway is no excuses. Investing even small amounts of money, relatively speaking, over long periods of time, well, they turn into piles of cash. And yes, there are plenty of relatively low-cost options that you can use to get started. So if you have any questions, you can always reach me via email, rob@robberger.com, and you can leave comments below the video on YouTube. I do monitor all of the comments and respond to them. Until next time, remember, the best thing money can buy is financial freedom.